All right, so we're going to get back to the second topic for the lecture today. There are only 34 slides, but we might take longer per slide on this deck, just because some of them have a lot of dense formulas in it. And if you look at the corresponding chapter in the book, chapter 14, there are lots of formulas, which means that we haven't had as many math problems, I think, in this second part of the course. That's going to change very quickly. So financial statement analysis. 1 through 4, there's number 1 has table 1414 as references it. In my textbook, it's on the next page. And I was kind of getting frustrated. Well, where's the table? And then, because I was looking back into the chapter, and then all of a sudden I turned the page over, and there's the table. So there is more accounting. I'm not an accounting professor. I did not do accounting as a major. So I know some tricks. I know how to weed through financial statements to get a sense for what's actually happening. But accounting is not my specialty. So if you ask me accounting questions, I'm very likely to say, go talk to your accounting professor. So I will do my best to talk about some accounting terms. I'm not really going to deal with inventory valuations, FIFO and LIFO. And so we'll leave it at that. So financial statements review, a quick review of what they are, what they look like, things to look out for. Talk about some financial statements ratios. And this is also going to incorporate something called the DuPont system, or the DuPont analysis. We're going to talk about free cash flows for the firm, which I have probably a slightly different way that I do free cash flows. And again, I learned this from my mentor. He's also a professor at UNC Charlotte. But free cash flows to the firm. It's the best way to get towards doing a valuation of a company in terms of their prospects for future business. The Graham technique. Benjamin Graham and David Dodd. Benjamin Graham's most famous student is Warren Buffett, who is now more famous than Benjamin Graham. At the time, he was not, in the investing community at least. So financial statements. Companies are required by regulators to submit, release, disclose financial performance results in financial statements, depending on the domicile of where they are regulated. Some companies are based in other countries, but are listed on the U.S. stock exchanges. They have to adhere to U.S. SEC regulations for quarterly disclosures of financial statements. In Europe, it's semi-annual. Now, in most forms, these statements must include, among other things, there are lots of things. If you pull up the annual statements, the 10Ks that have a huge list of disclosures and risks and things like that. But the most important thing about the filings is the financial statements of income, balance sheet, cash flow. So in the textbook, they have this example of Home Depot, and this is from their, I believe it's fiscal year 2017, but it ends at the end of January 2017. So it's mostly actually business that occurred in 2016. So most retail companies have their fiscal years end either at the end of January or the end of February. And that's because December is such a huge month for retail that Home Depot is different because it's a home goods, or home and building equipment. But retail shops typically, I think they usually have their fiscal years end at the end of February, because December is such a huge month and January is the worst month of the year, that they offset each other to reduce some of the seasonal volatility in their quarterly reporting. I mean, that's an aside. So in Home Depot, here's their income statement, and this goes all the way through. I was able to fit this whole one on the page. It's not true for the others. They have net sales. So they have, net of, sometimes they have some contra revenue items, returns, cost of goods sold, SG&A, selling, general, and administrative, other, and the depreciation. Okay, total operating expenses. So usually, if you take net sales and subtract cost of goods sold, that's usually called gross margin. So their gross margin here is about 32 million, roughly. So almost a little over, a little over 33% gross margin. Net sales minus cost of goods sold, is their gross profit, divided by net sales. Pretty good margin. Here's EBIT. It's also operating profit. That's what most people call that. Earnings before interest and taxes. I have interest expense. Now they have their taxable income, or earnings before tax, EBT. That leads to net income. They have dividends, so then it's quite a bit of dividends, don't you think? And then the remainder is what goes to their retained earnings. You'll also see that called, well, they don't have, sorry. They had dividends for preferred shares, and then after that would be income attributable to common equity shareholders. I don't think that Home Depot has preferred shareholders. So nothing really, surprising here. Interest, that's a pretty low interest amount, interest expense relative to their earnings. And here's their balance sheet. It's truncated, it's only a portion of it, so do keep that in mind. Current assets here, cash, receivables, so revenue that they've already marked but they haven't actually received the cash for, like for their Home Depot charge cards. Inventories, things that they have on hand. They have to have a lot of inventory because they have to sell it. People, they want to be able to sell someone on the spot, sell something to someone on the spot. Fixed assets here. Property, plant, and equipment. That's also called PP&E. And this is, usually they have another line item in the actual disclosures of accumulated depreciation and amortization. So you know how much in D and A is included in this $21.9 billion. Liability side, current liabilities, debt due for repayment. So that's long-term debt that was issued, but now it's less than 1 year. So now it becomes a current liability. It has to be paid in the current year, in the coming 12 months. Accounts payable, they have to pay for their suppliers. They have to pay actually having the inventory of goods. They've already been, their purchases have been recognized as revenue, but they have yet to send the cash payments over. Other liabilities could be short-term borrowings. Long-term debt, debt that's due in more than 12 months. Other long-term liabilities. It always makes me curious about what's in there. And in their disclosures, they usually have a little bit more detail when you pull up their actual filings. Here's the rest of their balance sheet. I had fixed assets up there. Then there's these intangible fixed assets. Goodwill. Patents are oftentimes included in intangible assets. Total assets, 42.966 billion in total assets. Here's the shareholders' equity portion. Retained earnings, 35,519. Common stock and other paid in. Why is it negative? Has anyone ever come across this? Does anyone recall what's it's called APIC, additional paid in capital? Do people remember hearing about that in accounting classes? Price above par. Yes. Sold shares. They sold shares and they received more in excess of par of value of the shares when they were originally issued, when they sold those shares to the market. But there's something else in here that's negative. That's peculiar. We'll come back to that later. Retained earnings. There we go, 35.5 billion. Look at that shareholders' equity. Look at the relative size of shareholders' equity to 42.966. It's about 10 times. Their assets are 10 times the amount of shareholder equity. How would you classify Home Depot? Slightly leveraged, moderately leveraged, very leveraged? How would you classify Home Depot? Very leveraged. 10 times. Depends on its competitors. Well, we can pull up Lowe's after this if you really want to. Is that not normal for retail? It depends. It depends. For Home Depot, they run a business probably with a very high level of accuracy. They don't have as much variability in any given year as some other retail shop. But remember, this isn't necessarily the same as retail. This is home improvement, so it's a little bit different. It is a little bit different than retail. Yes, long-term debt, 22.35 billion. It's pretty big. I would say it's pretty big. It differs on the revenue, but not on the expenses. True, but if the revenue is riskier, then it would be more difficult to be as leveraged, I would argue. Let's look at the cash flows. Let's see what we got here. And then, like most companies, they do what's called the indirect method for cash flows. They have net income. They add back depreciation, changes in working capital, decreases in receivables, decreases in inventory. So an increase shows up as a negative. Here we have cash flows from investments. These are cash flows from operations, cash flows from investments, gross investment in tangible fixed assets, minus 1.621 billion. And actually, let me pull up something while I'm doing this. Okay. Lastly, so it's cash flows from investments. This is cash flows from financing. Long-term debt, they issued an additional 2.2 billion, 2.27 billion in long-term debt. They issued shares, they subtracted shares. They repurchased them. So that's an outflow. Dividends is an outflow of cash. And these are financing activities. This is how they finance their operations. So right here, hopefully, what's going on with Home Depot? What's going on here? What are they doing? Taking out debt to buy treasury stock. That's exactly right. Treasury stock is a fancy word that just means that the company used cash that they have on hand, whether it's from issuing long-term debt or cash from operations, to buy back shares, and then they own the shares. So those shares have essentially been taken out of circulation. That's a big change. $6.66 billion. They only issued $2.27 billion. And so what are each of these terms? Retained earnings. What does that actually mean? And if anyone wants to give an attempt at any one of these, you're more than welcome to. I'll pause for a minute. Retained earnings, net income, net profit after dividends. Yes, but more specifically, accumulated over the life of the company. So it's not just net income, it's net income since the beginning of the company. Accumulated. Can a company have negative net retained earnings? Yes, they absolutely can. In fact, most companies, when they IPO, start out with negative retained earnings. Not even, Callum, not even if they have to pay more in dividends. They could even have negative retained earnings because since their inception, they have been incurring losses. They haven't yet turned a profit. And so I could probably pull up Tesla's financial statements from the first few years, and they had negative retained earnings for years until they started to return profits to generate profits. In fact, I'm not sure. Maybe they still have negative retained earnings. Let me check. It's entirely possible that they do. Tesla still has negative retained earnings, negative 5.4 billion. Yeah, lots of hotels are running on negative equity. Yeah, probably. Yes, there are companies that do, unfortunately, for periods of time, have dividend payout ratios in excess of 100%. I would advise against that. It's not a good idea. It's not a sustainable practice. Treasury stock, I mentioned that earlier. I think, have explained that. Oops, sorry. If you want me to come out to explain it again, let me know. These are also all in the book. APIC, additional paid in capital, when a company sells shares, whether it's a initial public offering or a seasoned public offering, or reselling treasury stock back to the open market. What's the additional amount in excess that they generated from selling that? So if they bought it back at 45, then they sold it at 50, that's $5 per share grossed up to however many shares that they sold. If they bought it at 50 and then sold it back at 45, well, there's going to be a negative hit to their APIC. It can go down, it can be negative. Weighted average cost of capital. I didn't see this in the book, which was disappointing to me, at least in this chapter. I'm sure that it's somewhere else. Has to do with their equity cost of capital, which, by the way, the standard practice is to use the CAPM to estimate a company's equity cost of capital, and their debt cost of capital. You take the weighted average of those two, and for the debt cost of capital, you also have to incorporate the fact that debt is tax deductible, the interest payments are. And so you have to take 1 minus the tax rate times the debt cost of capital, the after-tax cost of debt capital. These become very important next week when we talk about valuing a firm. Any questions? All right, so there are many financial ratios that you could go through. I'm not going to go through them all. I'm going to go through the ones that I think are most important. So from the textbook, return on equity, net income over shareholders' equity, that's from the financial statements. Return on assets, operating income, EBIT over total assets. Return on capital, EBIT divided by long-term capital, so long-term debt equity. And there are lots of things that you can do, especially with ROE and ROA. They call it the equity multiplier. I usually just call this leverage. Assets over shareholders' equity. The higher this number is, the more leveraged the company is. If a company has a lot of equity financing, this is going to be close to 1. If the company has a lot of debt financing, this could be 5, 10, 20. Gives you a sense of how leveraged they are. Interest coverage, and they said you can also call this times interest earned. EBIT over interest expense. How many times did your interest expense did you earn in the year? Another way of assessing how leveraged they are. Are they over leveraged based on their business? You can be leveraged on your capital structure, but not be over leveraged on your business model. Kind of an interesting idea, which we'll get back to Home Depot in a minute. Their interest coverage, we can calculate on our own, is not that great. Or is great, is very, very healthy, very safe. Debt to equity. Total liabilities divided by shareholders' equity. Oh, excuse me, that's incorrect. Oh, that's right. That's right. Total liabilities from the balance sheet over shareholders' equity. And some people just put debt over equity or D over E. They're all fine. So using a series of financial ratios, we can do something called the DuPont system. Return on equity is equal to the product of these 5 levers. The first one is called the tax burden ratio. There's not much a company can do about this. There are some things. The larger the company, the more they have access to little loopholes in the tax code, international tax codes. There was something that was called the Bermuda Triangle. Essentially, you set up a tax shelter in in Ireland, there's some sort of some sort of transfer pricing to the Netherlands, and you route it through Bermuda and somewhere through this through this whole process to avoid paying taxes. That's what Apple, Alphabet, or Google, Alphabet, Microsoft, they were all doing it. Ireland got in trouble recently for the EU said that that was against the EU laws and regulations. I think that they are appealing it. I think they may have actually won their appeal, but that doesn't mean that the legal battle is over. The tax burden. You can tweak it a little bit, but not all that much. Pre-tax profit over EBIT. Interest burden. So EBT over EBIT. Do you have to cover a lot in interest? So if you have to cover a lot, so if you have a lot of interest expense, this is going to be very low. If you don't have a lot of interest expense relative to your financial performance, your business performance, then this will be very high, close to 1. Excuse me. Oh, sorry. Yeah, this will be close to 1. If you have no interest expense, this will be 1. This last one is a measure of margin. How profitable is your business? EBIT, or operating margin, divided by revenue. Asset turnover. Are you in a asset-intensive, capital-intensive industry, like airlines, like manufacturing, like airplane manufacturing and defense? This last one is leverage. How much have you leveraged your equity? So each one of these levers, there's a little bit you can do with the tax burden, not too much, but each one of these can be adjusted. There's going to be some interrelationships here. So if you increase your leverage, that's going to reduce your interest burden ratio, which is actually bad. Can you improve the efficiency of your business and improve the margins? Can you increase your asset turnover, which means growing revenue? And so let's look at Home Depot. And so I put all those numbers here from those financial statements that we were just looking at. You plug them in. So there's net income. And actually, I think that this needs to also account for dividends, because they do have dividends. Let me see about that. Let's adjust that, please. So I think we need to have a dividend payout ratio in here too. Oh no, that's before dividends. Okay, good. So net income attributable to common shareholders, which includes the dividend payments that they're going to receive. or did receive. It's pretty high. That's actually surprising. Okay. 12,491. Yeah. The tax rate is pretty high, actually. I'm surprised that it's that high. It's lower now, I'm sure. So the next one, that's the interest burden. Remember, if it's close to 1, that's good, and they're at 0.93. So in terms of their leverage relative to their business model, they aren't that highly leveraged. They're doing okay. How about their operating margin? 14%. It's a pretty expensive business. The cost of the goods, the cost of having the property, that's a big store. Asset turnover, 2.2 times. Every year they go through their assets over 2 times in terms of revenue. Pretty good. And then here's that leverage, 9.9. Amazing. ROE, and this is taken as ROE of equity from end of year, which it probably should be end of prior year, but 183.6%. This is all just taken from the statements that were in the textbook. So it shows you how they can play with these levers a little bit. What if we leverage up a little bit more? What if we buy back some more shares? Interesting. What if we look at their most recent annual filings instead, which is what I have here? Okay. Well, their new net income over pre-tax profits, that's a bit big. Let me double check that. I've got the statements here. Let's see. Double check that I'm using the net earnings 12,866. Okay. Yeah. 12,866, great. So yes, their tax burden, their effective tax rate went down from fiscal year 2017 to fiscal year 2021. Their interest burden, it's relatively unchanged, I believe. Margin, I can't remember, was it 14% before? Yeah, 14. Went down, but not much, not anything meaningful. Their asset turnover went down though, going from 2.2 to 1.87. That's a little bit large, but oh my goodness. You thought 9.9 was leveraged. How about 21.4? Again, this is leverage on the balance sheet, not leverage against their business model. And as you can see from their business model, their interest, I'm going to do this. Interest burden ratio is very close to 1 still. So in terms of the way that they manage their cash flows relative to their debt risk, they're doing okay. So their ROE now is 390%. Now I can't really do ROE the way that I should, which is shareholders' equity from end of year last year, fiscal year 2020, which ended in, I think it was February of 2020. And let me show you why. It's a balance sheet. Balance sheet. Here is their shareholders' equity as of, was it February 2nd, 2020. I can't show you return on equity as I should because they had a negative value for equity. It's because they had, getting capital here, retained earnings there, but they had this minus 65.2 billion in treasury stock, the shares that they're buying back, actually drove their shareholders' equity to be negative. They still have a very solid retained earnings. It's just that they bought back a lot more shares. Kind of surprising. But it helps the share price go up. And I wonder, I didn't do my due diligence to find this out. I wonder if one of the metrics by which the CEO is awarded performance compensation is return on equity, which some companies do that. Then the executives, if their compensation is tied to return on equity, then the executives have an incentive to buy back shares and artificially increase return on equity without improving the net income part of that. So just by managing the company as is, but buying back shares, that could help them reach their incentive goal for the year. That's a governance issue. So let's look at these two side by side. Okay, so tax burden that improved, but that's not really due to anything that Home Depot can really control. They can control it a little bit, but not much. Interest burden, not really meaningfully different. Operating margin, a little bit lower, but not much. Asset turnover is a little bit lower, not much. But then leverage significantly increased. More than 2 times the amount of leverage. More than compensated for the fall in interest burden and the fall in operating and the fall in asset turnover. So that's how they're making their returns look better, increasing leverage. So capital structure, that's what this is, changing your share of debt versus equity, is a little bit of a, I don't want to call it a game, but it is a tool with which companies can try to improve their financial performance. Cost of debt capital is lower, typically. So if we look more at Home Depot, and I pulled this data from Bloomberg, it's not perfect, but it will work. And some people use the market value of equity, but I think that's silly. You should use the book value of equity, even though we're getting the cost of it using the market price. So how much of their assets are they actually financing with their equity shares. So debt capital, assets minus the book value of equity, 67.282 million, so 67.3 billion. Debt weighted average cost is 1.6% after taxes. Their equity on their balance sheet is 3.3 billion. Their equity cost of capital, again, it uses a CAPM model, is 10.7%. And we simply take the weighted average, 1.6% after tax, times the share of debt capital, and then cost of equity capital, 10.7%. It's just, there's no tax benefit, times the share of equity on the balance sheet. Their weighted average cost of capital is 2.025%. This is not in the textbook. But it is important. There's no way we can value the company without using market prices, which is kind of peculiar how, we use market prices to get the cost of equity capital, but we assume we have an equity cost of capital given to us. There's no way we can value the firm as an enterprise, the enterprise value, without first getting the weighted average cost of capital. What's the weighted average cost that they finance their operations? We use that ultimately as the discount rate for future cash flows. We also use it to assess, well, what's the economic value added? So essentially, we take the weighted average cost of capital, multiply it by their assets, that's how much they need to earn in order to break even from an economic perspective. Cost us 2.025% to finance these assets. We need to at least earn that in order for us to economically break even. If we earn anything in excess of that, then that would be economic profits. And here that's their economic value added. And you can turn it into a percent as a percent of assets. And there are other tricky things that can be done. This is taken from page 440 in the textbook, where you can have this relationship. The return on equity is going to equal 1 minus the tax rate times return on assets plus, remember, return on assets is EBIT, earnings before interest and tax. So I have to subtract interest. But we have to convert this to ratio of equity, so you use this ratio here. Now you might be thinking, wait, hold on, return on assets is divided by assets. So how can this hold true? Okay, bear with me. Return on equity is EBIT minus interest minus taxes divided by equity. That's the same thing as 1 minus the tax rate times EBIT times the interest rate times debt divided by equity. Okay, next line. EBIT is simply ROA times assets. Return on assets times assets gives you earnings before interest and tax. Interest expense, so minus R times debt, that's interest expense. All divided by equity. Stick with me, my story does get better. ROA times assets, that's the same thing as ROA times equity plus debt minus interest times debt, all divided by equity, which if you rearrange everything that's in this fraction, let me highlight it, And again, this is all in the textbook. If you rearrange this fraction around, you do get this term here. It's another way of representing return on equity. The DuPont system tells you which levers do you want to play with. And of course, they're interrelated. This would suggest as you increase debt relative to equity, as long as your ROA is greater than your interest rate, you should continue to increase your debt burden. You should continue to issue more debt. Once your ROA goes below your cost of debt capital, you should stop issuing more debt. If your goal is to maximize return on equity, which some companies and some executives, that is their goal. Some companies, that is part of their performance metric for their executives. And there have been lots of journal articles, academic articles, talking about the governance issues of having ROE as being one of the performance metrics for executives. Because all it really does is it incentivizes them to do more share buybacks than they probably should. So, any questions? I said thought it might end early. I don't think I am. Okay. So let's talk about free cash flow to the firm. And I'm a little bit disappointed that the book doesn't have it in this chapter, because this would be a perfect chapter to have it. I'm also a little bit confused as to why they have this chapter after the equity valuation, the firm valuation chapter. So, but little things. I jump around a lot, obviously. So, free cash flow to the firm. This is essentially, if you were to value the business by a string of cash flows, the only thing we want to value is the cash flows that this company is going to earn, assuming that it remains in existence forever. The cash flows we want to use are free cash flows to the firm. It's the cash flows which all stakeholders, common shareholders, preferred shareholders, bondholders, banks that have lent to the company, all have a stake, all have a share of these cash flows and are legally entitled to these cash flows as stakeholders in the company. So we start with net income. We add back interest expense. So it means, if interest expense is a minus sign, you turn it to a plus. You add back the amount of depreciation and amortization that was occurred, so that's usually subtracted. Now, this is peculiar because capital expenditure typically appears as a negative number in the cash flow, so you include that. Capital expenditure is a minus number, you put it minus. So I guess maybe subtract. To be more clear, let's do that. Subtract the amount of capital expenditures. Typically a negative value. Subtract the change in non-cash working capital. This is different from what's in the book. And the reason why I use non-cash working capital and why I was taught to use non-cash working capital is because when we essentially figure out what portion of the pie do the debt holders take, the first thing the debt holders get to keep is the cash. They immediately seize the cash and take control of the company. So you subtract cash from debt. Debt minus cash equals net debt. All right. Working capital is current assets minus current liabilities. So you start with net income, add back in the interest expense, so that's no longer subtracted from the income measure we're looking at. Add back in depreciation and amortization. That is an accounting treatment. That's allowing for incurring the expense of fixed capital over a longer period of time. That's not actually when the cash flow actually occurred. Incorporate capital expenditures, which is not counted as an expense. That's counted as a cash flow. It's an exchange of one asset for another, and that's why you find it on the cash flow statement. And subtract change in non-cash working capital, how they're using their balance sheet, their current portions of their balance sheet for managing their business. This gives you free cash flow to the firm. So, if we return back to Bodie, Kane, and Marcus's statements for Home Depot, here's net income, interest expense, depreciation and amortization, CapEx is entered as a negative item in their cash flow statement, current assets. Well, we have to know 2017 and 2016. We need to know both those snapshots. Cash and equivalents, again, we need to know both. Current liabilities. Okay, so let's start with working capital. Change in non-cash working capital, we take 17,724, subtract out the cash, subtract the current liabilities. That's this first term. Working capital for the year ended January 2017. Then we do the same thing for 2016. $16,993 minus the cash, which is $2.2 billion, minus the current liabilities, which is $12.5 billion. That's the second term. And we get change in working capital of negative $1.2 billion. So what does that actually mean? What does that actually mean for Home Depot? You would think that's bad because it's a negative number. But what they're actually doing, what that actually is kind of indicating, is that they are generating more cash by the way they manage their current assets and current liabilities. Yes, their current assets went up from 2016 to 2017, from 17 billion to 17.7 billion. But their current liabilities went up even more. Holdings of cash went up as well. So that really would indicate, let's see if I can do this really quick. So 17,724 minus 2,538. So their current liabilities excluding cash in 2017 was 15.186 billion. Their non-cash current assets in 2016 were 14 777 billion. So that's an increase of 409 million in non-cash current assets. So that does mean that they do have more in realized revenue, most likely, that they haven't received in cash. That's actually what's called a use of cash. They have increased their non-cash assets, which means that they have less cash on hand. But they've increased their current liabilities by 1.6 billion, roughly. That is a source of cash. They are waiting maybe 7 days longer to pay their suppliers. That is actually a strategy that companies do to manage their working capital. If you pay your suppliers a little bit later, you have more cash on hand. Now, you want to do that very judiciously, because if you wait too long, your suppliers might get upset. Home Depot probably has a lot of, you would call it a duopsony, minimal purchasers in this market. They are purchasing from the suppliers. Home Depot is a client of the suppliers. And between Home Depot and Lowe's Home Improvement, they have a pretty strong hold on the market for home improvement companies. There are others, but these two are behemoths, and they command a lot of pricing power from a purchaser perspective. So that actually means that they're using their working capital as a source of cash. It's really peculiar. It takes a little bit of time to essentially just accept it, or I did at least, and then work through the rationalization or the explanation one by one. What does it actually mean? So, going through this, free cash flow of the firm, 7.957, add back in interest expense, add back in depreciation and amortization, subtract the capital expenditures, which comes from the cash flow statement, and then incorporate that negative minus the change in the working capital. Now we have the actual cash flows where the stakeholders have a legal claim to that cash flow and all future cash flows of that nature. Any questions? While I'm waiting, this is a foundational part to actually valuing a company without using price ratios. Most analysts, professional, highly paid, highly regarded research analysts, simply use price ratios to value companies. Most successful investors do not. Also, if you're interested in understanding more about investment banking, mergers and acquisitions, what happens when the acquiring target, the acquisition target is not a publicly traded company? How do you value that company? There are ways to essentially estimate their equity cost of capital. It can be a bit tricky, but you can do it. But then you don't have a price ratio that you can use. All right. there are no questions, I'll talk about the Graham technique, then we will call it an evening. All right, so Benjamin Graham, probably one of the most influential investment theorists and practitioners of the 20th century. With his colleague David Dodd, they wrote the quintessential book on investing in 1934. This predates what is called modern portfolio theory. Their book was called Security Analysis. And again, I use quotes from modern portfolio theory, kind of a joke about how it's modern. It was, the first papers on it, I think, were in the 50s. So the whole premise is that markets often underprice companies relative to their fundamental value. Now, Graham, in his, I think he even says this in the Security Analysis, but Benjamin Graham had indicated in his findings that these mispricings typically take 1.5 to 2.5 years to correct, was his assessment. And I think it was more towards the 2.5 years end of the spectrum, but 1.5 to 2.5 years is around the correction time. So you have to hold them for at least a year, usually more than 2. Now the book has a very short section on it. I posted to Canvas a paper from the Financial Analyst Journal. That's the CFA Institute's publication. Let's see how many pages. I think their whole discussion takes up less than a full page on Graham. He had 10 criteria that he used a lot. And the paper that I posted actually does some a little bit of quantitative rigor. It was published in the late 80s, so it's a little old. But here are the 10 criteria. If you look at the first 1, 2, 3, 4, 5, those are more tied to equity performance, equity price performance, earnings performance. The second grouping of 5, the last one is earnings performance. Last 2 actually, so that's 5, 6, 7. 7 are tied to profitability and equity prices and earnings. The 3 here from the 6th bullet, 7, 8 to the 8th bullet are a little bit more tied to liabilities and debt management. So they need to have high earnings yields. This takes into account momentum here, the second criterion. Dividend yield has to be, dividend paying. All these things. If you have a company that's hitting on all of these, that's Benjamin Graham's target. Now the paper actually empirically went through and tested these, and it found that the 3 most important were these. Total debt, less than book value of equity. Home Depot does not meet that. Earnings yield has to be sufficiently high relative to market pricing of high-grade bonds. Dividend yield needs to be sufficiently high relative to pricing in high-grade bonds. But the idea he's trying to do is that the market pricing is out of sync. And this total debt less than book value of equity is essentially a safeguard against the company being too leveraged from a capital standpoint, from a capital structure standpoint. So Home Depot is too leveraged from a capital structure standpoint for a Graham company, a Graham investment. So this is Oppenheimer wrote this in 1984. So, really quickly, I did want to, just for interest's sake, someone had an interesting question about, let's look at the leverage of Lowe's real quick. I'll open it to questions. If you have a question, you go ahead and ask it either verbally or in the chat while I'm doing this. Oh, probably. Oh, I like, it's just so nice when a company takes the time to, on their website, put their financial statements in an easier to read format, and that they have these side by sides. That's always nice. So let's see, what's the measures I want to look at? Let's do interest burden. And the assets over equity. Okay, interest burden, let's see. All right, for the full year, it's 2021, operating income, 9,647, divided by pre-tax earnings, which is 7,739. Oh, sorry, it's reverse. 7,739 divided by 9,647. There we go, 80%. I believe that Home Depot was 93%, 92. See if I remember that correctly. Here it is. 93. Pre-tax profit over EBIT. Pre-tax profit of 7.7 over 9.6. So 13 percentage points lower. That already suggests to me that they have an even, potentially even higher level of leverage. Let's see. Balance sheets. All right. This is 2021. Yep, they sure do. Look at that. 46,735 divided by 1,437. 32.5 is their leverage ratio using for the DuPont system analysis. 32.5, and for Home Depot it was 21. So that's considerably more. Now, somewhere in here, I don't like that they don't have laid out the treasury stock. More specifically, it's 381, 366. So they're not really changing their capital structure. It does not look like they're actively buying back shares, which, to be honest, they really shouldn't be, in my opinion. So they are even more leveraged than Home Depot. So I just wanted to check that to address that question, which is a very good one, a very good point. You do have to consider, what are the, that specific industry, what is essentially the market willing to tolerate in terms of risk. And it depends on the reliability of financial performance of companies in that industry. If we were to look up, I mean, I hate to look up retail shops now because they're not going to be, it's not going to be an accurate snapshot of what they look like during normal times. But I do know that the department stores do use a lot of leverage. But what's a retail store to use? Let's just, for interest's sake, let's see what happens if we pull up Nordstrom. I'm going down a little bit of a rabbit hole, so if you have a question, stop me, ask me. If this is not interesting to you, you don't want to spend the time doing this, you do not have to sit on any longer. This is more just for exploration, looking at companies using this lens of how leveraged are they. I want the, see if that's it. Yeah, of course they wouldn't do that. Ah, here we are. $63. Here we are. Hey, where'd it go? All right, so back up to 37. All right, let's see. What is their interest burden ratio? So earnings before tax, $538. Nope. Let's go over here. 2019. And what's the fiscal year ending? Let's see, fiscal year ending. I'm going to presume that it's February. So let's see. So earnings before tax, 682 divided by earnings before interest and tax, 784. Theirs is 87%. So better than Lowe's, not as high as Home Depot. How about their leverage, total assets for 2020? So it would have been a little bit below that. We would have used 29. You're supposed to use the prior year, but just for the sake of it, what's their leverage? So 9,737 is their total assets divided by equity, 979. So they're about similarly levered as Home Depot, but about 6 percentage points lower on that interest burden, which is a bad thing. And this is, by the way, before the pandemic. February 1st, 2020. So it was just before all the lockdowns happened. Yes, people were jittery, but February 1st, 2020, they were still, for the most part, acting as though we're going to be okay. So with their leverages right now, which is sure much higher. Yep. 0.9538 divided by 305 is their current shareholder equity. They're 31 times levered assets over equity. So this is not representative of how they operate during normal times. Hopefully they don't take long to get back to some semblance of a more normal business environment for them, as well as the other department stores and other retailers, because this is having their equity fall by that much is very difficult to manage. Look at this accumulated deficit. That's their, it's not called retained earnings. It's accumulated deficit. Here's their APIC. Kind of interesting. I wasn't expecting their accumulated deficit to be quite this big. I didn't know it was going to be that big before the pandemic. So, all right, 5 passed, so I haven't really let you off the hook early tonight. Any questions, comments, concerns? All right, everyone, thank you for the time.